Dear students, today we will discuss the various functions of the capital market in India. Meaning: the capital market in India serves as a critical platform for facilitating the issuance, trading, and investment in various financial instruments. Its functions are multifaceted and contribute significantly to the economy. Here are the primary functions of the capital market in India. Mobilization of savings. The capital market channels savings from individuals and institutions towards productive investments. It provides avenues for investing surplus funds into securities like stocks, bonds, and derivatives, thereby facilitating economic growth. Facilitating capital formation. By enabling companies to raise long-term capital through the issuance of shares and bonds, the capital market aids in funding business expansion, infrastructure development, and other long-term projects critical for economic progress. Providing investment opportunities. It offers diverse investment options to investors, ranging from equity shares, debentures, government securities, mutual funds, to derivatives. This variety allows investors to diversify their portfolios based on risk appetite and investment goals. Ensuring liquidity. The capital market provides liquidity by offering a platform for buying and selling securities. Investors can easily convert their investments into cash through secondary market trading, enhancing market efficiency. Price determination. The market forces of demand and supply dictate the prices of securities in the capital market. Prices are determined through continuous trading, reflecting the perceived value and future prospects of the underlying assets. Corporate governance and transparency. Listed companies are subject to stringent disclosure norms and corporate governance standards imposed by regulatory bodies like SEBI, Securities and Exchange Board of India. This ensures transparency and accountability, fostering investor confidence. Facilitating risk management. Through derivative instruments like futures and options, the capital market provides tools for managing and hedging risks associated with price fluctuations in stocks, currencies, commodities, and interest rates. Facilitating economic growth. Efficient capital markets support economic growth by directing funds to productive sectors, encouraging entrepreneurship, and fostering innovation. This, in turn, contributes to employment generation and overall development. Enhancing financial inclusion. Initiatives like IPOs, initial public offerings, and mutual funds allow retail investors to participate in the wealth creation process, promoting financial inclusion and wealth distribution. Infrastructure development. The capital market plays a pivotal role in financing infrastructure projects critical for the country's development, including transportation, energy, and telecommunications. Name and explain the meaning of the instruments of money market and capital market briefly. In India, both the money market and the capital market offer various financial instruments serving distinct purposes and catering to different investment durations. Money market instruments. Treasury bills, T-bills. These are short-term debt instruments issued by the government with maturities ranging from 91 days, 182 days, and 364 days. They're used to raise short-term funds and are highly liquid, serving as a means for the government to manage its cash flow and meet short-term financial obligations. Commercial paper, CP. Commercial paper is an unsecured money market instrument issued by highly rated corporate entities to raise short-term funds. These have maturities ranging from 7 days to 1 year, providing companies with a means to finance immediate needs. Certificate of deposit, CD. Offered by banks, CDs are negotiable instruments with fixed maturity dates, ranging from 7 days to up to 1 year. They allow banks to raise funds from the public and other banks, offering a higher interest rate than regular savings accounts. Repurchase agreements. Repos involve the sale of securities with an agreement to repurchase them at a future date at a predetermined price. It's a short-term borrowing instrument typically used by banks and financial institutions to manage their liquidity needs. Capital market instruments. Equity shares represent ownership in a company and are traded on stock exchanges. They have no fixed maturity and are considered long-term investments. Investors can earn returns through dividends and capital appreciation. Debentures/bonds. Debentures and bonds are debt instruments issued by corporations or government entities to raise long-term funds. They have fixed interest rates and maturity periods, ranging from a few years to several decades. Preference shares. These shares carry a fixed dividend rate but do not offer voting rights. They are a hybrid instrument with characteristics of both equity and debt and often have a fixed maturity period. Mutual funds. Mutual funds pool money from multiple investors to invest in diversified portfolios of stocks, bonds, or other securities. They offer various schemes catering to different risk profiles and investment durations, including short-term debt funds and long-term equity funds. In summary, money market instruments like T-bills, CPS, CDs, and repos cater to short-term funding needs, typically with maturities ranging from a few days to a year. Capital market instruments like equity shares, debentures, preference shares, and mutual funds serve longer-term investment objectives, ranging from several years to indefinite periods.